Welcome back to Smart Money on CNBC TV18. Our guest today is Mrin Agarwal. She's a financial educator. She also runs Finsafe, and we're talking about a lot of the the interest that we're seeing in small savings schemes, basically the post office schemes. Mrin, before the break, we were talking about different schemes for women, right? For women empowerment, for women to be financially literate, for girl children as well. There's a Sukanya Samriddhi Yojana, which I want to talk about. It is a 21-year investment, so there's a big lock-in period. And going by historical data, in what condition should investors choose Sukanya Samriddhi Yojana over other products for their girl child?
So again, like in the case of PPF, we of course talked about some of the restrictive withdrawal rules for Sukanya Samriddhi. And honestly, I mean, these do work for the scheme because it's only when you have these sort of lock-ins that the scheme is actually going to work for you, right? I mean, if you allow withdrawals, then people tend to withdraw it. So, but again, what I would say is that today, I have always looked upon Sukanya Samriddhi. I've got two daughters and I have used Sukanya Samriddhi for, saving for them as well. But, what I would say is that just having money in Sukanya Samriddhi itself is not enough. And given the cost of education, especially if you're looking at it from education or even the cost of marriage these days, and the inflation on both of these things, I think what is really important is that we need to complement this scheme along with equity. Now, Sukanya Samriddhi again is a great scheme because it's triple E, so it's exempt, which means exempt at investment, exempt on the interest, and exempt on maturity. And again, it's giving you a 8% return. Of course, the returns are declared on a quarterly basis, but a 8% tax-free return kind of translates to about 11% return. So it's a pre-tax return. So it's a great investment as such. But I would say that it's a good idea to complement it with an equity investment, given the fact that inflation on education is more than 10%.
Okay, so I just want to get that graph up on the screen, the Sukanya Samriddhi Yojana, and how you can benefit from it. The amount that you invest is up to 1.5 lakhs a year. The interest rate is flat 8%. An 8-year return is about 17 lakhs, and a 12-year return is 30 lakhs. And this is, of course, particularly for your girl child. So if you have a girl child, this is a great plan for you. But as Mrin was also saying, since you start investing for your children from a very, very young age, they have a larger risk appetite and a longer time horizon, so they can really benefit from the power of compounding. Hence, along with Sukanya Samriddhi Yojana, it makes sense to put some amount in equities as well. But Mrin, what are the advantages as well as disadvantages of the regular return schemes like the SCSS, the post office MIS? How do these compare with an SWP in sort of a debt fund? I mean, just to compare these schemes with a debt fund.
Yeah, so for senior citizens, these are the three options that you have. You can do senior citizen savings schemes, you can do post office MIS, which are going to give you fixed returns, or you can do a SWP in a debt fund, right? Now, while these schemes, the fixed return schemes are extremely safe and they give you a fixed return, so you have visibility of returns. And the other advantage in SCSS is also the fact that, the rate doesn't change. So unlike PPF and Sukanya Samriddhi, where the rates are changing on a quarterly basis, the rates are not changing. And it's currently 8.2% paid quarterly. Of course, the post office MIS is lower. It's at 7.4% and it's paid on a monthly basis. Plus, you're able to, between both the schemes as husband and wife, you can actually invest around 69 lakhs. So I think that's a good amount that can be invested over there. And it also, the SCSS also qualifies for ATC deduction. I think the disadvantage, of course, is the fact that it's taxable. And, as we know, for senior citizens above 50,000 rupees interest, the TDS is going to kick in. So certainly, on a 30 lakh investment with interest being around 2,46,000, it's going to be entirely taxable for the individual. Also, rates may not keep pace with the inflation. And the fact is that as far as the senior citizen savings scheme is concerned, only people above 60 or people above 55 who've taken VRS can invest in this scheme. And hence, so if you're retiring at 50, this is not an option for you. And again, there is a lock-in, and there is a quite a steep, I think, withdrawal penalty, because the withdrawal penalty is on the invested amount and not on the interest. So I think these are some of the disadvantages on the senior citizen savings scheme. Now, how does the SWP rank with this? Well, I would actually say that I would actually first say that for any individual, try to maximize the senior citizens and the POMIS, and then go for the SWP, because the taxation of all three is the same. But the SCSS has visibility of returns, which the SWP obviously is going to give you a debt market link return. So there is going to be volatility out there.
Okay, so if you want to evaluate the place a post office scheme has in your portfolio, suppose I'm in this age group of say 35 to 40, right? And I'm starting off my investments. You spoke about all the post office schemes. Tell me, how do I allocate my money? Say I have 100 rupees. How much should I allocate to these schemes? How much should I put in debt? How much should I put in equity?
See, what I would say is, of course, that's dependent on your goals. And if you do have long-term goals, I would say the two schemes I would look at would be only PPF and SSY. And that is because they have tax efficiency. I wouldn't really look at any of the other schemes that are there. And again, the allocation would be based on what is your debt equity allocation. Clearly, I mean, these are going to come as part of your debt allocation. And as I said, that I think, SSY is particularly a very, very good scheme, given the fact that the pre-tax returns are somewhere in the range of about 11%. At present, I think SSY certainly is a very, very good option.
Okay, that is the Sukanya Samriddhi Yojana, right? All right, all right. Mrin, thanks a lot for joining in. Very helpful discussion here. Thanks and have a great weekend. With that, it's a wrap on this edition of Smart Money. Keep writing to us. We love receiving feedback from you. Have a great weekend. We'll be back bright and early on Monday.